Hey everyone, Colin here. We're running a short survey to get better information on who listens to the show, and we're giving away free block space gear if you fill it out. If you find value in our shows or listen consistently, you can do me a huge favor and fill out the form. It takes about 30 seconds and helps me and the block space team keep the show running. You can find a link to the survey in the show notes. Thanks. Hey y'all, welcome back to the Mining Pod. We've got a special edition this week with your boy Colin and your boy Will. We are going to be doing a breakdown of CoreWeave and what makes CoreWeave so special compared to other cloud companies and why they're the talk of the town right now. So no interview this week. It's just two lovely faces of the Mining Pod. Going to chop it up about the hottest tech stock of the summer. Today's show is brought to you by Fractal Bitcoin, but we'll learn more about them later in the show. For now, let's get right into it.
I want to take a second and talk about Colorado Air Filter, a new sponsor for the Mining Pod and a major supplier of air filtration systems for Bitcoin mining sites. Colorado Air Filter is currently running a summer sale on their inventory. From Mervate pleats to HEPA filters, shipments to installations, containers to retrofitted buildings, Colorado Air Filter has it all. Here's what one recent major miner had to say about working with Colorado Air Filter. Working with Keith and Colorado Air Filter has been a seamless experience from day one. Their filter media consistently meets the demands of our Bitcoin mining facilities, ensuring reliable airflow and equipment protection. Keith is responsive, knowledgeable, and understands the unique operational pressures in our industry. We value both the quality of the product and the outstanding service they provide. Units are ready to sell. Contact sales at coloradoairfilter.com using code MININGPOD to claim 15% off today. Again, that's sales at coloradoairfilter.com with code MININGPOD. We've had obviously tons of conversations around CoreWeave, and I think that it touches so many different aspects of Bitcoin mining right now. A lot of Bitcoin miners are patiently waiting for the bid from CoreWeave, like the pump, if you will. You know, Core Scientific got the pump, and then we've been seeing like Helios, Galaxy team got the pump, and now it's like who else is going to get it? We've also had the TeraWolf team on to talk about their Core 42 deal. So I think it makes sense for us to do some sort of digest. You and I did some homework for everyone. So if you are not familiar with CoreWeave, this is a good podcast for you. And if you are familiar with what they're doing, you might pick up some extra nuggets. So stick around. Much to talk about here. I think from a general perspective, I'll lay the groundwork for the conversation and then toss it back to you. Why are we talking about this in the first place? We'll touch on that in a second. Can I review some of the deals? The Neocloud model. Talk about like how does CoreWeave fit into the GPU stack? We are pretty familiar on the show with the Bitcoin mining stack, right? What is happening from the foundry level all the way up to people deploying Bitcoin miners in the field. There's a similar model for GPUs, so we'll talk about that. Then we'll go and talk about the financials and the energy stack. Those are obviously very intertwined, but how does CoreWeave make money? And then also how do they deploy their GPUs into the field? And finally, I think just touching on like what's bullish bearish about this, and less so in the sense of like, hey, should you buy the stock or not? And more so like, what's the path forward for a Neocloud hyperscaler, AI hyperscaler as they sort of pen themselves like CoreWeave? And how should you, who cares about Bitcoin mining stocks or cares about just the general data center industry, really think about someone like CoreWeave? And we've assembled a bunch of thoughts. That would probably be my last thing before we jump into is like Colin and I obviously are not experts on this, but we have done a lot of time in the Bitcoin mining industry as researchers and reporters. And so we're going to be using some of our sleuthing skills to put some data together for everyone. We have lots of different sources and we will be dropping all those into the show notes below, everything from the S1 for CoreWeave to some great newsletters that we've been peeling through. Colin, I'll throw it to you first for like laying the groundwork why a Bitcoin mining podcast is talking about CoreWeave, one of the most hyped IPOs of 2025.
Because CoreWeave is eating all of our beloved Bitcoin mining stocks. It's like you said, all these Bitcoin mining investors are waiting for the CoreWeave bid, but CoreWeave has kind of become this gravitational pit, this black hole, if you will, kind of sucking all of the conversation into its orbit. And I think that that's really the main reason why it's so germane right now. As Mining Pod listeners will know, we have been covering a lot of these AI and HPC pivots over the last year. It's the investment thesis du jour. In fact, we called for the peak of a US Bitcoin miner hash rate in one of our newsletters the other week, because I just don't really see how we're going to top the concentration of hash rate in publicly listed US companies and just privately held ones as well in the US, with all of the demand for AI and HPC and the kind of, I would say, bottleneck for power as well that we're seeing, right? We don't really have baseload projects on a mass scale throughout the US on the docket. There's some natural gas plants being planned. There's not much nuclear at all. In fact, I think there's only like a handful over the coming decade. And there's a bunch of solar, and there are batteries being rolled out as well that will help. But we really need baseload to service some of these HPC and AI compute loads, and miners are sitting on a lot of energy. Makes a lot of sense for them to sell that out to either a hyperscaler or build out IT services like we've seen with Core Scientific and some of these other ones. That, I think, to kind of put a bow on it, what I find really interesting about the CoreWeave conversation is CoreWeave itself obviously is born of the AI boom, but in a different way than maybe you might expect because of the way their Neocloud business model works. And we'll cover that in a second. But there's this convergence, right? With AI, when it came out, ChatGPT kind of took the internet by storm in the fall of 2022 and then really took off 2023 and 2024. You had this problem where all the traditional AI hyperscalers actually did not have enough compute on hand to meet the demand that they would need to train all of these models or to roll out new AI applications, right? Then that's where CoreWeave comes in. And then downstream of that even are the Bitcoin mining companies like Core Scientific that CoreWeave is now trying to buy out, Applied Digital, Galaxy Digital, and all these other ones that already have the infrastructure in place. It may not be AI infrastructure, but they've got warehouses, they've got electrical infrastructure, and most importantly, they have the power allotments, right? Mostly in the context of what we're talking about here, it's in Texas, right, with Galaxy and with Core Scientific as well. So like with the AI boom, you kind of had this domino effect, right? That kind of ultimately ends up at the Bitcoin miners who are sitting on these massive power assets and saying, well, actually, Bitcoin mining is a brutal business. The margins are thin and getting thinner, and it's really hard to actually recoup a profit on invested capital. But this AI and HPC thing is potentially more lucrative and also more consistent revenue. It's not fluctuating as wildly as it is with Bitcoin mining, where you have the difficulty adjustment, variable transaction fees, and obviously Bitcoin's price being super volatile. So CoreWeave is kind of at the center of this. And I think all of these miners are, in its orbit currently, or at least the AI conversation, the miners are in the orbit of that. And to contextualize a little bit more about what CoreWeave does before we get into some of the nitty gritty, I want to kind of just define that Neocloud definition, because that gets thrown around a lot. And I at least did not really appreciate what it meant until recently, or the straight skinny of it, as far as I can understand, is traditional hyperscalers, right? Like you have your Amazon Web Services, Google Cloud, all of those things. They provide compute services and virtual machines, but they also provide a suite of applications on top of that, whether that be like data sets, storage, other applications. Yeah, Will's got this great chart right here. Whereas what the Neoclouds are doing, and this goes back into the compute bottleneck, they're really just providing like bare bones GPU services, i.e. raw compute. So that's why you'll see a company like CoreWeave, right? Some people might scratch their heads and they think, okay, 72% of CoreWeave's revenue in Q1 came from Microsoft and OpenAI. Wouldn't these companies have somewhere else to go to for their compute? And the fact of the matter is they don't, because there's a huge bottleneck for it right now. And so these Neoclouds came out and they were really smart, and they decided to be nimble and say, what if we stripped out the layer of complexity on top of this with all the additional applications and just provided an environment for training models, for drawing raw compute for these tech companies that need it currently? And this also goes into another of CoreWeave's, how should we say, edges here, because they don't provide what's called hypervisor services on top of that. A hypervisor is a virtual machine environment that's basically a form of software that allows people to manage their compute loads with some of these hyperscalers. CoreWeave just did away with that, and they do what they call just bare metal services, where you're just going straight to the GPU and leveraging that. There's nothing else on top of it. This makes their latency for their services much lower, allows people to access them much more quickly and spin up virtual instances faster than they could for an Amazon, than like a competitor like Amazon Web Services. Like there's a quote from this deep dive we read, where a CEO of Cerebrium says, and for CoreWeave's GPUs, he can spin up an instance in 4 to 8 seconds, while Amazon Web Services need 90 plus. So that gives you kind of an idea. That was a long spiel. All of that to say, the reason we're talking about CoreWeave now is because the compute bottleneck and energy bottleneck is converging, and these new providers like CoreWeave are really starting to make a name for themselves. And I think it's important to understand that these are fundamentally different services than what we've seen from hyperscalers in the past.
Yeah, great summary there. So I'll take a step back on a few things, or I'll pick a few topics that you just talked about and reference them here. And then, of course, this is one piece that I'm throwing up on the screen that we're going to reference a few times, and we'll drop in the show notes. It's from the Artemis Big Fundamentals newsletter. They did a great deep dive, CoreWeave Fundamental Deep Dive. That's what they called it. And I thought it was excellent. So we'll drop that in the show notes. Everyone's looking around for what CoreWeave is going to do next. And on top of that, everyone's wondering what OpenAI is going to do next, because the demand for compute is just off the charts. Everyone knows that. It's a big hot ball of money. Bitcoin miners are looking for placement there, right? So the last week or so, you and I both have been on Twitter looking at some of the Iron guys talking their bags back and forth. And, I love it because that's the energy we want in this space. And their stock is up quite a bit month over month. I think it's up 80% month over month. It's, broke past $14-15 at this point. It was just $8 a little bit ago. And so people are looking at these stocks and being like, hey, maybe there's like a deal with one of these Neoclouds in place, or maybe there's something like that. And that's the case for a few of these Bitcoin miners. Like even the small guys, like the Hives of the world, are looking for more of this. We saw Bit Digital just pivot, and they broke their company in half. Half went to an Ethereum treasury company, Bit Digital part. They're going to sell their Bitcoin. And then the other part went to White Fiber, and they filed a confidential S1 describing that process. So this is happening all over Bitcoin mining. And, we're more interested, I think, in the Bitcoin mining side a lot of times because this GPU stuff gets pretty complex pretty quickly, and then gets into the world of Linux and all those things, and maybe not as strong of an interest for us, but it's certainly going to touch everything, and that's why we need to talk about it. We've talked about the mullet miner quite a bit, and shout out to Nick Gates for that phrase. The mullet miner describing ASICs in the back, GPUs in the front for these traditionally Bitcoin mining sites that are becoming more than that. They're becoming these Neocloud sites. So yeah, I want to talk about one other tweet I saw before we started jumping on here and podcasting, which was from Matthew Sigel, who will be coming on the podcast soon. And that's that Oracle and OpenAI have expanded their Stargate deal for more US data centers. They're considering sites in Texas, Michigan, Wisconsin, Wyoming, New Mexico, Georgia, Ohio, and Pennsylvania. Of course, I think most people know these numbers, but I'll say them again. It's a $500 billion initiative. It's unclear if even the first $100 billion has been deployed yet, but it's between SoftBank, Oracle, and OpenAI. It's a lot of money, and a lot of these Bitcoin miners are looking for that. That $500 billion is crazy multiples larger than most of the market caps of any Bitcoin miner. Right? The largest Bitcoin miner market cap isn't even going to be over 10 billion right now. So it's a lot of money for whoever's going to end up getting these contracts, which brings us back to CoreWeave. It's been securing long-term contracts, 4 to 6 years, securing a lot of revenue. And then it's been going and buying GPUs and buying land for those things. And that's what we're going to jump into as those two topics. I'll pull back up this graphic that I had up a second ago, and it shows the emerging Neocloud world here. And I think it's a great representative. So if you're watching on YouTube, this is probably the best place to take a look at it. I can kind of describe it on audio. But just like you said, Colin, this chart from Semi-Analysis shows that you have on the left your traditional hyperscalers, Microsoft, Oracle, AWS, Google. Then you have your Neocloud giants. It's going to be your CoreWeave, your Lambda, your Crusoe, and Nebius. Crusoe is a new one also, and also formerly a Bitcoin mining company. They just sold all their assets to NYDIG recently. So, they pivoted out. And a few Semi-Analysis pieces, which we've also pulled on for this podcast, mention how Crusoe's, new here. also in sense of learning how to construct these things. And companies have been taking sort of a risk on them to be able to do that. Now it's paying out so far, like it's going really well. And Crusoe has experience building out data centers and executing on top of them, but they're not like one of these other traditional data center builds. CoreWeave, accompanies Crusoe in terms of like formerly being a miner of some sort in the crypto industry, CoreWeave being an Ethereum miner. And then last thing I'll note is this emerging Neocloud model. Now there's other groups underneath it, like they mentioned brokers, software providers, VC clusters, and sovereign cloud, which just refers to other providers. But the Neoclouds is the one that's of interest, I think, for Bitcoin miners. And we see a few familiar names on here. They have Iris Energy. Of course, it's IREN now. But there's also Hut 8 on here, Bitdeer Cloud. I don't see Hive on here, but I think they could be on there. Maybe they're a little too small.
Yeah, I think if you're going to put Iron, you got to put Hive, right? Same with Hut 8.
Yeah, it might be a little small, but those three names are the most interesting for our audience, which, probably care about that a little bit. So I'll toss it back to you to keep the conversation going, but that's, in a 15-minute preamble why we're talking about the subject and lays some of the terminology out.
Yeah, maybe we should hop into the operational and financial side of CoreWeave. Just one thing to note, though, about putting Crusoe on there, I wonder, and I could be speaking from outdated information and total ignorance about this, but it was interesting because Crusoe kind of slowly eased their way into the HPC landscape by deploying data centers on oil and gas sites. And I wonder how much of that gives them a kind of different edge over something like CoreWeave, because you actually have the energy on site. But you're also usually probably operating much smaller clusters as a result. They're just geographically distributed. Obviously, this is changing with the Lancium deal, right? That's going to be a massive data center in Abilene, Texas. I believe it's somewhere between 1 and 2 gigawatts. Something
right now, the build is 880 megawatts. Okay. And then I think like the plan is to build out more. Some of these numbers, of course, running around are like press release numbers. Which one side note on this is just funny is like we're finding out that it's not just Bitcoin miners doing these press releases. It's like everybody, like anyone who has an announcement is just going to like make it bigger than it actually is. So we've hammered Bitcoin miners for years for like these ASIC deployments that are way too big or not realistic, and now we're just, it's another industry. It's another day in marketing. Go ahead though.
It's all PR talk. All PR talk.
Yeah, it really is.
That's kind of the trick with a lot of this stuff is you have to figure out how to cut through the noise, because half of what we're working with is either not totally honest or it's like technically correct, but not 100% correct. Anyway, that was the last thing I wanted to say about some of those Neoclouds with Crusoe. And one note, maybe to dive into CoreWeave a little bit more, is that Neocloud model, at least on CoreWeave's end, gives them kind of a hyperscaler acumen, or at least reputation in the space, right? As that Artemis fundamentals, big fundamentals newsletter notes, and I quote, it is the only non-hyperscaler capable of reliably operating massive GPU clusters, currently managing over 250,000 GPUs across its global infrastructure. Yeah, which is pretty incredible. And going back to the Neocloud advantage and that bare metal service that they offer, where they're stripping out all of the other software and just giving bare bones raw GPU compute. Quote, what differentiated and jump-started CoreWeave was a simple architectural choice. Instead of using hypervisor, a common layer of software that manages virtual machines in most cloud environments, CoreWeave ran workloads directly on physical hardware. I know I'm highlighting that again. I just think it's really important to note, so when people see CoreWeave being valued at $70 billion, that's a multiple on their revenue. I believe that's like gives them just over 12x multiple on their annualized revenue if we look at Q1 numbers. But people are also kind of looking at this new model and saying this is innovation within the data center space. And so they're maybe attaching a little bit of a premium to that.
Definitely. Yeah, I mean, it's a ton of GPUs and the management of it is really important. So like you mentioned, they're making as close to bare metal as possible. The two most noteworthy companies that want that is one, NVIDIA, which has an investment, owns about 5% in CoreWeave, and then also OpenAI. And they're doing that because they want to have as much control over the GPUs as possible. NVIDIA uses a lot of the CoreWeave GPUs that are deployed for training their own models and training their own future build outs. Like, how do we build out better GPUs? Well, we test our own. And then for OpenAI, they want more granular control over how they run these GPUs as well. So by offering that bare metal approach where you're not having like slices of software in between, you open yourself up to these different customers. It's helped differentiate them. They offer a few other services as well that apply to others. We're not going to get into too much of that because I don't think it's something you or I are necessarily well versed in. Maybe we can get a Linux specialist on one day.
Yeah.
But I do think it's worth.
I was seeing all these terms. I was like, this is industry jargon I'm not ready for.
Miners, are you ready to earn more with what you already have? That's what Fractal Bitcoin is for. Scaling Bitcoin with Bitcoin using a fully compatible recursive design. In just 7 months, Fractal's hit 18 million users and nearly 2 billion transactions. Fractal's cadence mining reduces up to 50% of your pool fee. No new hardware, no extra energy, and it's easy. FB rewards go straight to your existing Bitcoin wallet address. Over 90% of Bitcoin's hash power is already merge mining Fractal. Get more from the same resources. Start on Fractal today. So let's pivot to something I think you and I can speak to a little bit better besides Linux vocab words, which is energy. As of their S1, which we use for this, and it's a little dated right now, obviously, but we can use it for context. They have 360 megawatts of active power, 1.3 gigawatts contracted, and they have a further pipeline after that. I don't love mentioning pipelines because a lot of people have pipelines. It doesn't really mean anything. The most important and impressive deals they have in the books for our audience would be the 500 megawatt deal with Core Scientific, and then the Helios build for 393 megawatts of critical IT load. That's a lot of power that's contracted in one area. They also have a lot of sites internationally. They have 32 sites altogether, and they have a new London office as of May 2024, and a few build out projects in Norway, Spain, elsewhere. And they're looking for the international market as potential growth sector for them. But the US, North America continues to be of interest, and they are prospecting sites all over North America. So those are two notes on the energy side of things. The European side of stuff is definitely smaller by multiples. It's about 40 megawatts is active in Sweden, and I don't even have the numbers for Canada and Norway, but not Canada, Norway, Norway, UK, and Spain, but definitely smaller in those sort of areas. Throw it over to you. Any thoughts on the energy pipeline or any additional notes?
So just going back to the size of their international footprint, if we look at their Q1 revenue, it was 981.6 million, and 929 million of that came from the United States, and all other countries 52 million. So I think that's probably going to be a big focus for them in terms of growth in the future. It's going to be difficult though in Europe, right? I mean, Europe just generally has much higher electricity prices. Obviously, they've got data centers all over the continent, but it's just the scope of the industry is not nearly as large as it is in the US. And as this blog post that we're referencing, our newsletter, the Artemis Fundamentals, says U.S. revenue growth was 425% year over year. International revenue surged by 354%, but it's still basically 20th of the U.S. revenue. In terms of some of the deals for the Bitcoin miners, just to re-highlight them, there's the 590 megawatts with Core Scientific. We'll see where the acquisition talks go with that. Seems like that's probably pretty likely at this point. And that to me is interesting signal for maybe where CoreWeave's head is at in terms of what it wants to do to scale going forward. I would be very shocked if we didn't see similar kind of lease to own deals with some of these companies that they are involved with. They've got 250 megawatts with Applied Digital. That's 2 15-year leases. And then, like you said, the Galaxy Digital is 393 megawatts combined for 15 years. There's also some that went under the radar. There's this one with Digital Crossroads in Hammond, Indiana. It's a 180 megawatt new build. The term of the lease is 20 years. And it looks like that's not planned until about 2027, though, for when the hookup's going to happen with the grid. So I think that's the other thing that kind of stands out with CoreWeave for me is we always see the Bitcoin miner deal as partly because there are these press releases that the Bitcoin miners want to get out to pump their stock prices. But I think you mentioned it, Will. You said, what, 42 sites internationally?
32 sites.
32?
Yeah.
So 32 sites internationally. There's so much going on in the background with CoreWeave that we don't even see. Now, I do think that the one like with Core Scientific, Core Scientific is their largest infrastructure partner. And that's part of the reason I think why the acquisition talks are happening currently. They want to own all of that power, right? Whether or not they buy out all of Core Scientific's data centers, I think is a big question that people have. You know, the first and foremost, as Nick Hansen of Luxor said on last week's roundup, you got to dispose of the Bitcoin mining assets if you're CoreWeave in that instance. Like if you're buying out all of Core Scientific, then you're going to just go ahead and get rid of all of that, maybe sell off certain data centers that aren't necessarily optimal for HPC and AI workloads, right? Those that are maybe a little further out from population centers. But if they do buy all of Core Scientific, and assuming that they can just replicate the playbook again with the sites that are being retrofitted, they have a pretty big pipeline for expansion, I think. And that's also probably where their head is at with that acquisition.
And the Galaxy acquisition, or the Galaxy acquisition. Whew, that would be that'd be a scoop right there. No,
big scoop.
The Galaxy expansion, I should say. There's also like a lot of numbers around this. Galaxy is expecting to get upwards of 2 gigawatts deployed in that area, and they have a clear pipeline for that because that site has just been on the ERCOT queue for so long. And who has first priority? In a lot of ways, CoreWeave has priority over a ton of this. So we'll continue to expect CoreWeave to deploy with either Core Scientific and Galaxy Digital as of recording. Who knows what things look like in 1 year, which brings us to the revenue side of things. I think that's a good place to spend the next 10, 15 minutes and just talk about what's happening with them. The first thing to note is that the revenue concentration is pretty high among a few customers. This was noted during the IPO process. So if you're glazing over right now, stick with us because we'll get to some more of the breakdown details of the GPU side of things. But Microsoft takes up about 62% of their 2024 revenue. And of their top 2 customers, that's 77% of the revenue. Now, since then, they've deployed a larger deal with OpenAI that has like $10 billion or so going forward. And they have a lot of long-term contracts and some smaller contracts as well with companies like Jane Street, the HFT firm. And so some people knock them, say like, this is not great to have someone like a Microsoft, which obviously is continuously and always building out new data center operations and options to be on your books like that. On the flip side, they have about $15 billion plus in contracted revenue as of recording. That's a pretty solid place to be. And so they're going to be able to continue to do that. Their model also works that they don't overextend themselves by purchasing a lot of GPUs and assets before they need it. They typically purchase the GPUs once an order is fulfilled. They get a 10 to 15% upfront payment for any sort of capacity that is booked by various organizations like OpenAI. Then they have the land deployment options that they've been cultivating through, one of these Bitcoin mining operations or other sources. And then they start deploying it over time. This allows them to have more flexibility. That prepayment allows them to get the GPUs from NVIDIA. And then they have this various power pipeline that they're able to fill into capacity. And they're doing that currently, right? These sites with Core Scientific and with Galaxy have different sort of options on who's paying for the Capex of building these things out, but they're building it out through 2026, 2027, et cetera. I'll note the NVIDIA thing as something that's really important. And we'll talk about this in the GPU rentals or the GPU which I say like revenue breakdown we'll do in a second. So the NVIDIA relationship is really strong. And it's actually one of the reasons that they're able to have such high profit margins and ARR because they're able to get GPUs before a lot of other people. They're the first to get these to market and deployment, which enables them to get the beginning life cycle of a GPU. We'll throw a chart up here in a second, but if you think of an ASIC lifecycle, right, when you first get the ASIC right out of the box from Bitmain, the top of the market, whatever difficulty and price is at, you have the longevity of that ASIC for, say, 3 to 5 years, depending on how well you treat it. And that beginning cycle, typically, but not always, is the best point to deploy that ASIC because of hash price economics. Difficulty could change and Bitcoin price could rip. And so that's not always the case. But for GPUs, we typically just see like straight degradation over time where it becomes not as useful to use. And so the quicker you get that GPU on the rack, the more profit you make up front, which betters your profit margins. And that's something that's fundamental, as noted in this newsletter from Matt Turek, is that they get that GPU before everyone else. And so their revenue over the lifetime of the GPU is better than everyone else's, and it allows them to have higher margins, which really does make the whole business hum along. And so they note this as being one of the most important parts of their business model, and it's a huge moat for them. If they didn't have it, they probably wouldn't be as hot of a tech stock at the moment. I'll pause there for you to throw some comments, though.
I think the NVIDIA thing is one of the more interesting aspects of their business. The fact that this company that was, 7 years ago was mining Ethereum, right, with GPUs, now has a direct line with the most important company, arguably, in the entire AI boom. The ones selling the shovels and the picks. The other thing that allows them to do is they can kind of test things in production with NVIDIA. They can test different softwares, different training environments, and things like that. So it's this incredibly important symbiotic relationship between the two of them. Moving forward a little bit, let's do a breakdown of like Capex and revenue for these GPUs. I'm glad that you mentioned the contract structure for CoreWeave's clients. They take that upfront payment. Like you said, they don't overextend themselves. They order the GPUs that they will need for that contract after they receive the upfront payment. And then it's about a 3-month deployment timeline. Then they take the rest of the payment in monthly installments. They discount the end of the contract life. They discount or give a rebate rather on the payments for the end of the contract with their client from that upfront payment. And this allows them to keep their financing costs rather low. They also can say that they're booking the revenue ahead of time, then use that and the GPUs to collateralize some of these loans that they have to get, which could typically have like pretty high interest rates. I mean, I think I saw some figure somewhere in the ballpark of like 10 or 12%, which is, for some Bitcoin miners, they're looking at 20% for some of the machine-backed loans, but that's still 10 to 12%, quite a lot. You're going to want to make sure that you're churning enough revenue to pay that back, obviously. But let's go to Artemis really quickly, because they had a nice kind of hypothetical. And now I do want to emphasize that this is a hypothetical, right? Like, we don't actually have CoreWeave's cost structure outside of what they report in their financials, but we certainly don't have, the granularity of what they're charging for their contracts with their customers and things like that. But nonetheless, I think this is probably pretty close to the mark. And I want to just do a quick comparison between this and a Bitcoin mining Capex and revenue analysis on back of the napkin math to show you why so many miners are deciding to go this route. So the Capex breakdown that Artemis provides here for a cluster of H100s, that's 8 GPUs. Total Capex spend is $264,000. That assumes $25K for each GPU, another $64,000 for infrastructure costs on top of that. Now, they can charge $3 per GPU hour for these H100s. And then if you're assuming a 90% utilization rate, that breaks down to roughly $189,000 per year in terms of annual revenue. Now, if we look at what this would look like if they were going to spend that money on Bitcoin miners, it kind of paints the picture perfectly. So if we're assuming that a miner is going to buy 3 or 8 S21 pluses, they're going to be purchasing more than what they're going to be purchasing boatloads of these things, right? So they would get a little bit of a discount, but using some data from Luxor's hardware trading desk website, we get about $3,759 per S21. That ends up being S21 plus. That ends up being roughly 30K in Capex for those ASICs. At current hash price levels, those would be making those ASICs in total will be making about $111 per day. So that comes out to $40,753 annually, and that assumes 100% uptime. If we assume 90% uptime, you're looking at about $37,000 annually for those ASICs, and that's just at current hash price levels, right? So I'm not even applying any sort of a model for or sensitivity table for what hash price could be a year from now. I mean, if we assume conservatively that it's going to be $50 per petahash per day, you're looking at, basically a almost 20 or 15% haircut or so on that annual revenue from what we just did on the back of the napkin math. So caveat with this, obviously this is looking at CoreWeave as a pure play GPU service provider versus Bitcoin mining as a pure play miner. This is not the revenue. The revenue that we mentioned for CoreWeave is not revenue that like Core Scientific or Galaxy is going to be making from CoreWeave as an infrastructure provider. So I just want to say that, kind of get ahead of maybe some of the criticisms for doing this comparison, because obviously like those are different things, right? Like maybe a better comparison would be looking at how much a Bitcoin mining host can make, this pure infrastructure provider. I do think though that it underscores the point of what we talked about at the beginning of the episode. Why are we talking about CoreWeave now? Why are Bitcoin miners talking about AI and HPC? And it's in the numbers. It's just a much more consistent revenue business. And in a lot of cases, if you do it right, the margins are larger. Now that will change, no doubt, I think, as more entrants come into the space. But I thought that was interesting. And the last thing I would point out on this is it looks at the power cost per year. This is probably on the lower end on this Artemis article. For that cluster, it estimates about a $3,311 electricity bill. That assumes like 7.5 cent power. As I understand it, a lot of these critical IT data centers actually have a higher power bill than some of the other data, like than a Bitcoin miner, right? Part of that is because they demand consistent uptime. They actually have much more infrastructure outside of just the GPUs themselves that they have to service, cooling infrastructure, things of that nature, backup power and whatnot. So as I understand, they're actually typically paying more for those megawatts, but kind of a nitpick thing, but
no,
decent,
great points.
Decent Capex and revenue analysis. And yeah, I mean,
pick it up.
You can't beat it. You can't beat it if you're a Bitcoin miner.
No, you can't beat it. And then there's the multiple thing that we'll talk about probably at the end here when you become public. I have some other stats I wanted to share just because I thought it was interesting, and it takes like a different way of looking at it. So it looks at a GPU over a 5-year period, and you're taking into account your power costs, operational costs, interest costs, infrastructure cost, and then obviously you're amortizing the GPU over the period as well. So looking at this model, which we'll throw up on screen for those on YouTube, you can see that there's a lot of different IRRs based on those input costs, of course. And the input cost that matters the most really is like when you get the ASIC, because or when you get the GPU rather, because you are able to get higher revenue off the bat. One of the most interesting things that I found about this is like the power cost actually doesn't matter as much. And that's a huge thing when I think we talk about Bitcoin mining is like we need power, you need cheap power. And I think that's because the hash price is so variable, right? And like you have like all these other costs that become important. It's just not as a lucrative business as the GPU market. So you noted there, like a lot of these companies have higher cost to power, and it's because they can kind of stomach the bill. When you have a GPU and you have thousands of these GPUs earning $3 an hour, like over time, you really start to see that these things scale. They also seem to last a little bit longer than Bitcoin ASIC because there's no difficulty. So I think that's just one thing to note or two things to know, I should say, is getting the GPU earlier matters, and two, the power doesn't matter quite as much. What does matter, if you look at the IRR over time, is that number can change a lot depending on your cost of capital. Colin, you noted like the interest rate, if it goes up or down, you really do get into a weird spot where like you have problems because your cost of capital is going to start eating into your margin pretty significantly. And again, if you don't get the GPU before other people do, and you're getting an older model, that also hurts you. So those are a few things I want to know. I'll read this quote just to kind of break it down a little bit. Assuming a 10% annual decline in H100 rental prices starting from $3 an hour per year in year one, the price would fall to $270 in year two, $243 in year three, $219 in year four, and $197 in year five. This mirrors the A100's historical price trend and highlights a key challenge for spot-based providers, rapidly shrinking margins. In our simulation, if CoreWeave had relied on spot prices instead of fixed contracts, its return on invested capital would decline from 12.4% to 2% over 5 years, essentially making the business barely profitable. One key takeaway is that CoreWeave's partnership with NVIDIA isn't merely optional, it forms the core of CoreWeave's competitive moat. So again, I just want to emphasize that getting the GPU early is really what makes CoreWeave sing. They just have that access, they have that moat, which I think a few other of these Neoclouds are trying to form those relationships, notably with AMD, the biggest competitor to NVIDIA. But that remains to be seen if that can happen. And the second thing, obviously, that CoreWeave is tapping is its familiarity with the Bitcoin mining industry and these large sinks of power that they can pull on. Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin. Okay, so let's land the plane and really ask the question everyone wants. And you've slogged through 45 minutes to get to the answer, should you buy the stock or not? And we are here to give you a resounding maybe you should buy it, because we don't give investment advice on the podcast. But I do think it's worth going through some of the different fundamentals. So I found this piece really helpful. It's another newsletter called Mostly Metrics, and they basically just do breakdowns of various companies and kind of look at, obviously, the metrics. And at the end, they had a bull case and a bear case here. And I thought it was just worth kind of zipping through these different bullet points here. The bull case, the AI compute super cycle continues. A valuation over 40 billion, 20x forward revenue multiple. They're all already over this, right? Like the market's already valuing them this way. This is around the time of their IPO. And I think that after reviewing it last night and thinking through some of these things, the case continues. First, the AI models sizes and compute needs keep growing, fueling GPU demand. CoreWeave remains a key player, benefiting from scarcity pricing. I think we've seen that continue to happen, though Oracle and some of these other Stargate projects do make the long-term future interesting. Revenue skyrockets beyond expectations. AI startups and enterprises lock in long-term contracts. I think this is a really important one that can be sort of lost. There's a few companies out there that are going after this enterprise model. If you think about all the different large conglomerations that are going to start integrating AI into their tech stacks, it's not something to be overlooked. Our friends over at Digital Wildcatters have been working on a project called Collide, and it's basically an AI project or an AI interface for the oil and gas industry that helps you sort of size the scope of whether to do a project. There's tons of stuff in there. They could probably go on for a little bit. And at first glance, you might be like, okay, why do you need a ChatGPT wrapper for the oil and gas industry? Well, the answer is this is like really sophisticated knowledge. And you're basically trying to get rid of a middle manager at one of these oil and gas companies. And that's what their platform is going to do. That's worth the cost of trying to figure out how to get these AI systems to work. And you're going to need a lot of GPUs to make that happen, which benefits CoreWeave. A few other points in here. Microsoft and other hyperscalers continue outsourcing AI workloads. The gross margin might expand as CoreWeave improves efficiency. Public markets might reward AI infrastructure stocks. I think we've definitely seen that one happen. And then just the stock price surging IPO, which we obviously saw that happen. Unless you have any thoughts, I'll go down to the bear case, which I found pretty interesting. Maybe a few things have actually happened. Again, this post was put up around the time of the IPO, so it's slightly dated. The bear case puts them at a valuation of between 10 and 15 billion, or 5 to 7x. It's typically where you see Bitcoin mining stocks also in that 5 to 6x on the revenue. Microsoft, AWS, Google ramp up their AI compute offerings. We've seen that happening, and we talked about that with Oracle and OpenAI deal that's happening right now. It was just announced on Bloomberg Terminal this afternoon as of recording Wednesday, July 2nd. The GPU supply chain constraints ease. A lot of talk about that in 2024, how GPUs were super hot again. And it's funny to revisit that, Colin, because like you and I have talked about that from the gamers versus the Ethereum miners in the past. Yeah. And now it's like actually matters because it's like a pretty big industry. Customer concentration risk materializes. Microsoft or another major AI startup pulls back. I think I'm less worried about this because a lot of the revenue is already contracted and obligated for the next 2 years. But if Microsoft did pull out and start building their own data centers or start focusing on owning their own logistics, that could be a concern. The cash burn accelerates. There's a lot of cash burn. We didn't even go into some of those metrics because it might take a little bit to explain, but they do burn a lot of cash, even though their revenue continues to go up year over year. And then the last 2 points, just like a post-IPO, there's some struggle. CoreWeave pivots or gets acquired, things like that. I think one thing I'll throw in here too is the lockups after 180 days happen and people kind of dump out. There's quite a bit of insiders getting stocks on this one if you go through the S1. And so that might be some sort of concern. But overall, I found like it to be like a pretty good representative of both the bull and bear case for CoreWeave. We are 3+ months since our IPO. Some of this stuff has already played out. And now the question is, can CoreWeave continue to sign energy deals for cheap and execute on deploying GPUs? They seem to be doing both those things. Any final thoughts on your side? I got one final thought, but I want to get yours first.
Yeah, I mean, going to the bear case, I think one of the things is the bear case is AI ends up being a bunch of hot air and no one really uses it. I don't think that that's playing out at all, right? I mean, this is kind of a perpetual argument on Twitter, is people saying, oh, this is actually, it's just a language model. It's not, consciousness or anything. And anytime I see that, I just think, well, are you actually using these things? Because anyone who's not impressed by what they can do, to me, is just either cynical or not paying attention. And so, I mean, they kind of, I guess, address that in the bear case. But the other one I would address is just the idea of like Google and all and Microsoft and all these other ones just taking AI in-house and building their own data centers. That certainly would be maybe a concern. Like you said, a decade out. These contracts for CoreWeave typically are 5 to 6 years for these clients. So at least in the near term, that's not a huge consideration. But what I would respond to that is just to go back to the whole concept of a Neocloud to begin with, and why CoreWeave has found itself in this position. If that were the case, they'd be doing it, right?
Yeah.
And they are trying to do it, right? You had Microsoft have that big that huge contract with Constellation Energy for restarting 3 Mile Island, right? To make sure that it can have enough energy for its own data centers. But they're going to do a little bit of both. I think, though, that going back to the interesting thing with CoreWeave is like CoreWeave is filling a need and a niche right now where there just currently is not enough capacity for these things. And if you assume that that is not necessarily going to change in the future and that there's only going to be exponential demand for these AI services, I don't really see why they would be stepping out of that role or overshadowed by some of the traditional hyperscalers building their own facilities. Because the fact of the matter is there's not enough energy to go around. And also there's only going to be increased demand for these tools. So
one last thing I wanted to throw out there for the Bitcoin mining side of things, and this actually is a thought and idea I'm going to steal from Penny Ether, who was chatting about these Bitcoin mining stocks with, is do you want this concentration with CoreWeave for your company? I think TeraWulf is in a cool place because that Core 42 deal, they have a lot of cash coming from essentially a sovereign fund, and they're just able to build these clusters, deploy them, build new clusters, deploy them. And if you go back to that podcast we did with Nas over at TerraWolf a few weeks ago, you'll notice that he's just talking about it as an engineering problem, right? It's not too complex. They have the cash on hand. There's demand for these things. The economics make sense. Right now, it's an engineering project. Dig out a foundation, drop some pad mounts in the ground, start building, a power shell on top, and then the companies are going to come in and put in their GPUs. And I think for some of these other companies, they're thinking about it the same way. It's a coveted spot to get one of these relationships with CoreWeave. But if you're a Bitcoin mining company and you're looking for, long-term success, do you want to be in this basket with other companies? Or do you want to have a differentiation and be working with a different Neocloud or a different provider? And so it's something just to consider as like Iron and some of these other teams are looking for either Neocloud, host partners, or others. Hut 8 is building that huge site in Louisiana. We know that there's going to be continued interest for Iron to sign someone for their 2 gigawatts out in Texas. And there's others looking for other places to get filled. So that's my last thought on it is like, do you want to be with CoreWeave or not? Colin, I think we touched a lot, so I'm out of ideas and thoughts. If you are interested in any of these research notes, we will drop them below. They're definitely worth giving a read if you want to take it in a different medium than audio. Happy 4th. We're recording this after the 4th, so everyone's going to be sad and back to work. That's a bummer.
Boo. I hope y'all blew some shit up. Hey everyone, Colin here. We're running a short survey to get better information on who listens to the show, and we're giving away free block space gear if you fill it out. If you find value in our shows or listen consistently, you can do me a huge favor and fill out the form. It takes about 30 seconds and helps me and the block space team keep the show running. You can find a link to the survey in the show notes. Thanks.